All insights shared in this video are purely personal and do not suggest any form of recommendation. How does the global economy look like amidst the pandemic situation? Globally, as reiterated by the International Monetary Fund, recession looms across all major economies. Technology is in many ways helping us deal with various disruptions from the pandemic. People around the world rely on information, communication, and technology using video conferencing and online collaborative tools to work from home and communicate with friends and relatives. Most of us are definitely using Facebook, WhatsApp, Instagram, some of us Pinterest too, streaming of music and video to playing games. All of that is happening, helping us in one way sail through our self-imposed quarantine. Schools and colleges are delivering online sessions for their students. However, the tech industry is not recession-proof. Comparatively, it is in a much better place to handle the crisis when compared to hospitality sectors like travel, tourism, and the hotel industry. Cancelled flight, restrictions and travel ban, vacant hotel rooms all would add to the worries of the services sector. Entertainment industry would lie dormant for quite some time, except for the ones who rely on online delivery of their content. Companies that primarily rely on exporting software or those who have outsourcing contracts could see a variation due to fewer contracts being renewed, considering the global crisis where everyone would get into the savings mode and stay conservative. Capital protection, savings, risk hedging against inflation, defensive investment strategies, and minimal expenditure would be the motto of individuals as well as institutions. Unemployment is another growing concern across sectors. People intensive businesses would have to optimize their capital expenditure and operational or production costs, which would lead to labor reduction. Because saving on labor costs is very important to stay buoyant during these troubled times. Supply chain disruptions due to the coronavirus are likely to increase the cost of business for manufacturing and construction companies. Inflation is another concern that would force customers to look at alternatives even in the retail segment. Historically, during recessions, some industries have done reasonably well. These are industries where demand remains inelastic to changes in prices and incomes. Therefore, the volume of consumer demand is relatively stable. Healthcare, food, consumer supplies, and basic transportation are examples of inelastic industries that could perform well in recessions. Agriculture markets are well supplied globally, but trade restrictions and supply chain decoupling could yet raise food security issues in some places. The pandemic and efforts to contain it have triggered an unprecedented collapse in oil demand, therefore resulting in an oil price crash. E-commerce operators, telecom and teleconferencing companies have huge opportunities right now. In the US market, the energy, financial, and industrial sectors performed the worst so far during this pandemic, with losses reported of 56%, 43%, and 42% respectively. Sectors such as real estate and materials lost nearly as much and dipped by 38% and 36% respectively. Healthcare, on the other side, is an attractive sector seen as a defensive stand too through the end of 2020, and it's showing a lot of momentum. As per the latest global outlook projection of South Asia by World Bank, GDP in the region is projected to contract by 2.7%. Uncertainty about the course of pandemic makes private investment frozen. In India, growth is estimated to have slowed to 4.2% in fiscal year 1920, which ended in March 2020. Output is projected to contract by 3.2% in fiscal year 2021, when the impact of the pandemic will largely strike. Going by the July 2020 data shared by the Center for Monitoring Indian Economy, the financial sector is supposedly heading for consolidation across its segments. Household income growth has been hit very hard. Traffic in major ports has shown slight improvement in June. Salaried jobs have had a nosedive. CapEx implementation has been stalled heavily, and so is the case with a lot of projects, and new investment proposals are at an all time low. Quite surprisingly, consumer sentiments show an obscure improvement. Real economic sectors such as financials, industrial, materials, and even energy could come roaring back in the second half of the year, provided there is a vaccine for coronavirus and the economy is in a position to open up 100%. Rebounds in the market depend on several factors such as future earnings growth, higher inflation, and a falling US dollar. Traditional defensive investments are utilities and healthcare sectors. Certain specific stocks and industries that do well during a recession may not always do well when the economy recovers later. You might want to change your investment strategy when good times return. I would stay optimistic. Let's listen to what the Nobel laureate Paul Krugman has to say. Welcome, Paul.
I'm an optimist about the potential for a rapid recovery, but I'm now getting very, very worried about the very near future.
Thank you, Paul. If volatility stays throughout 2020, I would like to play defense on the equity side of my portfolio. Investors can certainly pick up blue chips available at attractive prices or even look for the best time during a market correction. FMCG, pharma, information technology, healthcare supplies, telecom, transportation are a handful that looks attractive to me in the present context. I would choose wisely, and so should you. Thank you for listening. Stay safe and God bless you.